Hey everyone, welcome back for another deep dive. Today we're tackling something I know a lot of you are interested in, investment portfolio strategies.
Always a hot topic.
Yeah, and we're getting our insights from a YouTube video by Tae Kim. You might know him as the financial tortoise, called 9 Most Popular Investment Portfolio Strategies.
Good stuff.
What really caught my eye was how he debunks this myth of the perfect investment portfolio.
Yeah, that's a big one. He's right on the money with that. See, the thing is, markets are always changing, right?
Right.
So predicting what'll outperform everything else year after year, it's basically impossible.
So where do we even begin if there's no magic formula?
Instead of chasing this perfect portfolio, it makes more sense to think about a strategy that fits your own risk tolerance.
Makes sense.
And your goals, of course.
Okay, so no need to stress about finding some holy grail of investments, right?
Exactly.
But he does mention some general principles to keep in mind, like diversification.
Yeah, diversification is key. You want to
Yeah.
spread your investments across different assets.
So you're not putting all your eggs in one basket, basically.
Exactly. If one part of your portfolio is not doing so well, another part might be picking up the slack. It's all about managing that risk.
So a diversified portfolio helps you ride out those market ups and downs.
Exactly.
This is all starting to make sense now. So let's get into the specific strategies Tae Kim outlines. He starts with the simplest one, the one fund strategy.
Right. That one's all about putting 100% of your investment into a broad market index fund.
Like S&P 500.
Yeah, or the total stock market index.
What?
He uses those Vanguard funds, VFIAX and VTSAX, as examples.
He actually highlights people who've made millions using this simple strategy. It's amazing what consistent long-term investing can do.
It really is. But I think it's important to say the strategy isn't for everyone.
He does mention that, yeah. It can be pretty volatile, especially you get closer to retirement. Why is that?
Well, you're fully exposed to the stock market swings, right? If the market takes a dip right before you retire, it could really impact your plans.
Yeah, you don't want that. Okay, so maybe not the best for those who need stability and predictable returns, which brings us to the two-fund strategy. Okay, this one adds a little more balance, right?
Exactly. You combine a total stock market index fund like VTSAX with a total bond market index fund like VBTLX. You start with a higher percentage in stocks for growth and then gradually shift towards bonds as you get closer to retirement.
This reminds me of Warren Buffett recommending 90% stocks, 10% bonds for his wife's trust.
It's the same idea, a classic approach a lot of financial advisors recommend.
So bonds, they don't grow as fast as stocks, but they offer that stability.
Right, and they help cushion your portfolio during market downturns, which is especially important as you head into retirement.
So bonds act as that shock absorber.
Precisely.
Okay, now things get more interesting with the next strategy, the three-fund strategy favored by the Bogleheads.
It takes the two-fund approach and adds a total international stock market index fund, like VTIAX. You're diversifying even further by including exposure to companies outside the U.S. market.
Tae Kim mentioned there's some debate around international funds. Some say they're essential, others say they're not really necessary.
Yeah, there are arguments on both sides. Some argue that many U.S. companies are already globally diversified, so you're indirectly getting international exposure anyway.
And others think you need direct investment for true diversification.
Exactly, to capture those growth opportunities in different parts of the world.
What does Tae Kim think?
He doesn't have a definitive answer, but he personally includes international funds in his own portfolio just as an added layer of diversification.
To be on the safe side.
Kind of, yeah. It's a way to manage risk without sacrificing too much potential return.
Makes sense.
All right.
Let's keep going. What's next?
Well, Tae Kim has a variation of that three-fund strategy. He calls it the three-fund plus one.
Plus one.
Yeah, and the plus one is a REIT fund.
A REIT fund. Remind me what that is.
It stands for Real Estate Investment Trust. They're like mutual funds, but for real estate.
So you're basically investing in properties.
Right, a bunch of different properties, office buildings, apartments, even things like data centers.
So you're diversifying within the real estate asset class.
Exactly.
Tae Kim mentions the Vanguard Real Estate Index Fund, VGSLX, as an example. Is he a big fan of REITs?
He likes the convenience and diversification they offer, but he personally prefers owning actual properties.
Oh, interesting.
He says there can be tax advantages to direct ownership, and you have more control.
Makes sense.
But he gets that REITs can be a good option for investors who want exposure to real estate without all the hassles of being a landlord.
Right, right. All right, let's shift gears and talk about Dave Ramsey's approach. He's got his own four-fund strategy.
Yeah, and it's a bit different. Most notably, there are no bonds.
No bonds at all.
Nope. He recommends dividing your portfolio equally between 4 types of mutual funds. growth and income, growth, aggressive growth, and international. Tae Kim uses the Vanguard funds VFIX, VIMAX, VSMAX, and VTIX to represent these.
Wow, so it's all stocks. That seems pretty aggressive.
It is. His philosophy is that over the long term, stocks have historically outperformed other asset classes.
So you maximize your growth potential.
But, of course, this comes with higher volatility, might not be suitable for everyone, especially those with a lower risk tolerance.
Yeah, or a shorter time horizon.
Right. Tae Kim seems to like Ramsey's personal finance advice in general, but he's not totally on board with this particular strategy.
Yeah, he raises some concerns, the lack of bonds being a big one.
For sure. Bonds are crucial for providing stability, especially as you approach retirement.
An all-equity portfolio can really swing in value.
And that can be nerve-wracking for some investors.
Especially if those swings happen at the wrong time.
Exactly.
So maybe not the most balanced approach. But besides the lack of bonds, are there other differences between Ramsey's strategy and the three-fund portfolio?
Well, they both include international exposure, so that's a similarity. But the difference is in how they approach U.S. equities. Ramsey splits U.S. stocks into three separate categories: growth and income, growth and aggressive growth.
Whereas the three-fund strategy uses a single total stock market index fund.
Right.
So is Ramsey's approach with the three separate funds just adding unnecessary complexity?
That's a good question. Some would say it's overly granular and doesn't necessarily lead to better performance.
Okay.
The argument for a total stock market index fund is that it's simple, broadly diversified, and captures the overall performance of the U.S. stock market.
And breaking it down into three funds might not add much value.
Right, and could even lead to overlapping holdings.
I see. So many options to consider. Speaking of options, let's move on to the No-Brainer Portfolio by Bill Bernstein.
Ah, yes. Bill Bernstein is a fascinating guy. He's a neurologist,
Yeah, I read that. Board certified with a PhD in chemistry.
A true Renaissance man.
It's amazing how someone with such a diverse background became a renowned financial expert. How does his medical background inform his investing?
It's all about taking a calm, logical approach to investing, avoiding those emotional biases.
So don't panic when the market dips.
Exactly. And don't get greedy when things are going up. Just stick to the plan.
Makes sense. So what does his portfolio look like?
He recommends an equal allocation across 4 asset classes: bonds, European stocks, U.S. small-cap stocks, and the S&P 500. He uses VBTLX, VUSX, VSMAX, and VFIX for those.
A globally diversified portfolio with a mix of different asset classes. Seems like a solid foundation.
He keeps it simple. He really believes investing shouldn't be overly complex.
Okay, on to a strategy that sounds a bit more intimidating. The Ivy League endowment strategy.
This one tries to mimic how those prestigious universities manage their huge endowment funds.
Talk about big money.
Yeah, billions of dollars. But as Tae Kim points out, it's tough for individual investors to fully replicate.
Why is that?
A big chunk of these endowments are in alternative investments like private equity and venture capital. The average investor can't really access those.
So what does the accessible part of this strategy look like?
Using Vanguard funds, it'd be something like 35% in VTSAX for U.S. equity, 28% in VBTLX for bonds, 15% in VTIAX for foreign equity, 11% in VCMDX for commodities, and 11% in VGSLX for real estate.
They have a pretty big allocation to real estate and commodities.
Right, that's a key part of the strategy. They see these alternative investments as a way to diversify and potentially boost returns.
Tae Kim did mention some skepticism about the commodity fund VCMDX.
Rightfully so. Commodities can be volatile, and that fund is actively managed, which means higher fees.
Okay.
But the idea of including commodities in a portfolio is worth considering.
They can be a hedge against inflation.
Exactly.
So even if we don't copy the entire Ivy League strategy, there might be some takeaways.
Definitely.
Speaking of takeaways, let's talk about the coffeehouse portfolio. It sounds like a mix of everything.
This one comes from Bill Schultheis, the coffeehouse investor. It's well diversified and leans heavily on bonds.
How heavily?
A 40% allocation to VBTLX.
Wow, that's a lot.
The remaining 60% is spread across different funds representing different market segments, including the S&P 500, value stocks, small-cap stocks, REITs, and international stocks. He uses VFIX, VVIX, VSMAX, VSI, VGSLX, and VTAX for those.
It does sound pretty comprehensive.
Yeah.
But Tae Kim mentioned some potential drawbacks. He thought it might be too much for some investors to manage.
Right. With 6 different funds, there's a chance of overlapping holdings.
I see.
And with so many moving parts, rebalancing can get complicated.
Makes sense. Okay, brace yourself for the last one. Tae Kim calls it the ultimate buy and hold
Oh,
portfolio.
yeah. This one's from Paul Merriman. He aims to capture a wide range of equity asset classes. We're talking 11 different funds.
11. That's a lot to keep track of.
It is. He uses a whole bunch of Vanguard funds.
Yeah.
VFIAX, VSIX, VGSLX, VTIX, VTIX, VTIXX, VFSX, and VMAX, and a few others without perfect Vanguard equivalents.
What's the upside of this granular approach?
The potential benefit is that by capturing specific market segments, you might be able to get higher returns.
But the downside is the complexity.
Exactly. Rebalancing 11 different funds on a regular basis could be a real headache.
It sounds like a trade-off between potential returns and the effort to maintain it.
Right. It's definitely something to think about.
Okay, we've covered a lot of ground here. We went from the one fund strategy all the way to the 11 fund portfolio.
Quite the journey.
So what are the key takeaways for our listener who's trying to make sense of all this information?
I think the most important takeaway, and Tae Kim really hits this point home, is that there's no perfect portfolio. The real key is to choose a strategy you understand, one that aligns with your risk tolerance and goals, and most importantly, one you can stick with for the long run.
Consistency is key. It's like that saying, slow and steady wins the race.
Absolutely. Trying to time the market or chase hot stocks is usually a recipe for disaster. A well-thought-out portfolio strategy that you can stick with, even when the market gets bumpy, is much more likely to lead to success in the long run.
That's a great reminder. It's easy to make impulsive decisions when you see the market going up or down, but staying disciplined is crucial.
You got it. And remember, investing isn't just about picking the right stocks or funds. It's also about managing your emotions. Fear and greed can be your worst enemies as an investor.
Okay, so consistency, discipline, and keeping those emotions in check. What other insights should our listener be taking away from this?
I think it's worth emphasizing diversification again. It's one of the most powerful tools investors have for managing risks.
That safety net we talked about earlier.
Exactly. And diversification doesn't just mean different types of assets. It also means different companies, sectors, even geographic regions. The more diversified your portfolio, the more resilient it'll be to those market swings.
So diversification is a must. But how does our listener figure out their own risk tolerance and investment goals? Those seem pretty important for choosing a strategy.
They are crucial. Figuring out your risk tolerance is personal, and there are a few things to consider.
Like what?
Well, think about your time horizon. If you're investing for a long-term goal, like retirement, you can typically handle more risk because you have more time to recover from losses. But for a short-term goal, like a down payment on a house, you'll probably want to be more conservative.
Makes sense. What else?
Your overall financial situation. How secure is your income? Do you have a lot of debt? How much can you comfortably invest without stressing?
Okay, time horizon, financial situation,
It's
and
in your personality. Some people just naturally don't like risk. They might be uncomfortable with big swings in their portfolio, even if they have a long time horizon. Others might be okay with volatility and even like the excitement of taking on more risk. There's no right or wrong. It's about knowing your comfort level.
it's like a personality test, but for your investments.
I like that.
Yeah.
And once you understand your risk tolerance, you can think about your investment goals.
How should people approach defining those?
Be specific. Don't just say, I want to retire comfortably. Figure out how much money you'll need, by what age. The more specific you are, the easier it is to make a plan to reach those goals.
So it's like setting financial milestones.
Exactly. And each milestone might have a different time horizon and risk tolerance. Your retirement goal might be 30 years away, and you might be comfortable with more risk there, but your goal to buy a house might only be 5 years away, so you'd be more conservative.
This is helpful, like creating a roadmap for our listeners' investment journey.
Exactly. And remember, that roadmap's not set in stone. Your goals and risk tolerance might change, so it's important to look at your plan every so often and make adjustments as needed.
Now, Tae Kim focuses mainly on index funds, which are a great starting point. But are there other asset classes or investment styles our listener might consider?
Absolutely.